Welcome, future millionaire. Today, I'm pulling back the curtain on my personal investing journey to show you how I built significant wealth. This isn't a get-rich-quick scheme. It's about smart, sustainable strategies that anyone can implement. This video is for anyone looking to build wealth over time, understand the fundamentals of investing, and avoid common pitfalls. By the end, you'll have a clear roadmap to start your own path towards financial freedom. Let's get started. My journey to financial freedom wasn't a sprint. It was a marathon of consistent learning and disciplined action. For years, I researched, experimented, and refined my approach. What I've learned is that genuine wealth building isn't about chasing fads or relying on luck. It's about understanding fundamental principles, setting clear goals, and staying patient. Forget the myths you hear about overnight success. True wealth is built through consistent, informed decisions over time. My aim is to demystify investing for you and provide a practical framework you can use. Before we dive into strategies, it's crucial to understand the foundational concepts. Investing might seem complex with all its jargon, but at its core, it's quite simple. Think of it as planting a seed and allowing it to grow over time. The better you understand the soil, water, and sunlight it needs, the better your chances of a bountiful harvest. This section will break down the essential elements you need to grasp to start your investing journey with confidence. So what exactly is investing? It's the act of committing money or capital to an endeavor with the expectation of obtaining an additional income or profit. Why is it important? Because inflation erodes the value of your money over time if it just sits in a savings account. Investing allows your money to work for you, potentially growing faster than inflation and helping you reach your financial goals. It's about securing your future and building long-term financial security. Let's demystify some key terms you'll encounter. Stocks represent ownership in a company. When you buy a stock, you own a tiny piece of that business. Bonds are essentially loans you make to a government or corporation, and they pay you interest. Mutual funds are professionally managed portfolios of stocks, bonds, or other investments, offering diversification. ETFs, or exchange-traded funds, are similar to mutual funds but trade like stocks on an exchange. Understanding these basics is your first step. The most powerful concept in investing, especially for beginners, is compounding. It's often called the eighth wonder of the world. Compounding is simply earning returns on your initial investment and on the accumulated returns from previous periods. It means your money grows exponentially over time. The earlier you start, the more time compounding has to work its magic. Even small, consistent investments can grow into substantial wealth over decades, thanks to this incredible force. Now that you understand the basics, the next crucial step is setting clear financial goals. Without goals, your investing strategy will lack direction. Are you saving for a down payment on a house, your child's education, retirement, or something else entirely? Your goals will influence your investment choices, your risk tolerance, and your timeline. This section will guide you through defining what you want to achieve with your money. It's important to differentiate between short-term and long-term goals. Short-term goals, like saving for a vacation next year, typically require lower-risk investments because you'll need the money soon. Long-term goals, such as retirement planning 30 years from now, allow for more aggressive, higher growth potential investments because you have time to recover from market fluctuations. Clarity on your timeline is essential for making appropriate investment decisions. Your risk tolerance is how comfortable you are with the potential for your investments to lose value. Some people can stomach significant dips in the market, while others prefer more stable, albeit slower, growth. Your investment timeline is closely linked to this. Generally, the longer your investment horizon, the more risk you can afford to take, as you have more time for the market to recover from downturns. Be honest with yourself about your comfort level to avoid making emotional decisions later on. Before you even think about buying stocks or bonds, you need to build a strong financial foundation. This critical step ensures you're investing from a position of strength, not desperation. It's like building a house. You wouldn't start on the roof before laying a solid foundation. Neglecting these initial steps can lead to unnecessary financial stress and hinder your long-term investing success. Let's look at what constitutes a strong foundation. First, establish an emergency fund. This is a liquid savings account with enough money to cover 3 to 6 months of essential living expenses. It acts as a financial safety net, preventing you from having to sell investments at a loss if unexpected expenses arise. Second, tackle high-interest debt, like credit card debt. The interest rates on these debts are often so high that they negate any potential returns you'd get from investing. Paying them off is essentially a guaranteed return on your money. Once your emergency fund is solid and high-interest debt is gone, It's time to budget for investments. Treat investing like any other essential bill. Decide how much you can comfortably allocate each month and automate that transfer to your investment account. This strategy, known as, quote, paying yourself first, ensures you consistently contribute to your financial future. Even small, regular contributions add up significantly over time due to compounding. With your foundation in place, you're ready to choose the right investment vehicles for your goals and risk tolerance. There's a vast array of options, and the best choice depends on your individual circumstances. This section will introduce you to some of the most popular and effective investment options for beginners, emphasizing strategies that promote diversification and long-term growth. We'll focus on simplicity and efficiency. For most beginners, low-cost index funds and exchange-traded funds, ETFs, are excellent starting points. Index funds track a specific market index, like the S&P 500, giving you instant diversification across hundreds of companies with a single investment. ETFs offer similar benefits, often with even lower expense ratios. They are simple, effective, and provide broad market exposure, reducing the risk associated with individual stock picking. This is how many successful investors start. While index funds and ETFs are fantastic core holdings, you might eventually explore other avenues. Individual stocks offer the potential for higher returns, but also higher risk, requiring more research. Real estate can provide rental income and appreciation, but demands significant capital and management. Alternatives like cryptocurrencies or commodities are even higher risk and generally not recommended for beginners. Start simple, then explore as your knowledge grows. One of the biggest mistakes new investors make is reacting emotionally to market fluctuations. Successful investing isn't about timing the market. It's about time in the market. This section will emphasize the importance of diversification and adopting a long-term mindset, two pillars of my million-dollar strategy. These principles help you navigate volatility and ensure sustainable growth over decades, not days. Diversification is key. It means spreading your investments across different asset classes, industries, and geographies. This prevents your entire portfolio from being devastated if one particular investment performs poorly. Think of it like this. If you put all your eggs in one basket and drop it, all your eggs are gone. But if you spread them across multiple baskets, you might lose a few, but not all of them. Diversification helps manage risk without sacrificing returns. Patience and discipline are your best friends in investing. Don't panic during market downturns. Instead, view them as opportunities. Dollar cost averaging, which involves investing a fixed amount of money at regular intervals, regardless of market fluctuations, is a powerful discipline strategy. It ensures you buy more shares when prices are low and fewer when prices are high, averaging out your cost over time. This removes emotion from investing and promotes consistent growth. So there you have it, my million-dollar strategy for beginners. We've covered understanding the basics, setting clear goals, building a strong financial foundation, choosing appropriate investment vehicles, and embracing diversification with a long-term mindset. Your first steps to financial freedom begin now. Build your emergency fund, pay off high-interest debt, automate your investments into low-cost index funds or ETFs, and commit to consistent, patient investing. The journey won't be without bumps, but with these principles, you're well on your way to building lasting wealth. Start today. Your future self will thank you.